you want an exposure to a market or an
Everything they need in one place.
Being the world's foremost authority on individuals, advisors and institutions.
Hello and welcome to the Morningstar series, Ask the Expert. I'm Emma Wall and here with me today is Ben Yearsley, Head of Investment Research for Charles Stanley. Hello Ben.
Hi.
So it's an investment trust week this week and we're here to talk about VCTs. What is a VCT?
A VCT is a form of investment company that quite simply invests in some of the smallest companies in the UK, up to 10, 12, 15 million pounds in size, mostly unquoted, or they could be AIM. But the idea is they invest in these companies, help them mature and grow over 5, 6, 7 years, and then sell them and then reinvest the proceeds in more.
And what exactly is the benefit to the investor of investing in a VCT?
I shouldn't talk about the tax benefits first, but I will. The tax benefits are one of the major benefits. You get upfront tax relief of 30%. So put your £10,000 in, you get £3,000 knocked off your tax bill. You get tax-free dividends and tax-free growth. Tax-free growth, largely irrelevant because most of the profits are paid out as tax-free dividends. So you'll get a regular stream of tax-free dividends every 6 months from your chosen VCTs.
And we've seen some tax-efficient investment vehicles come under the cosh from both the media and indeed HMRC. Are VCTs protected? Should we be worried that the next government is going to pull them from us?
There's always that danger, but they're quite small. I mean, last year about £425 million was raised. So you're only talking a tax rebate of around about £130 million per tax year. The difference with VCTs compared to a lot of these other schemes that get the press and get all the weekend press is these are proper schemes that are actually investing in proper companies. A lot of the other products are, I wouldn't say tax dodges because that's unfair, but they're certainly ways of mitigating tax without actually making any real investments. These have to invest in proper companies that employ people that do things and might make things, but they have to do things.
And we've talked about the benefits. The benefits to the companies are obvious. They're getting seed funding at a time when they need it, when perhaps, especially at the moment, banks wouldn't step in. With investing with smaller companies, there are more likely to be exponential growth, but there's also the risks because smaller companies are more likely to fail.
I think you've got to get in context what VCTs are. Now, a lot of people think that they are these really, really micro companies, 5 employees, 10 employees, and that's actually quite rare. That's what they might have been intended to be in the first place back when they were set up in 1995. But actually, most of these businesses might have 50 employees or 100 employees. Most tend to be profitable. And so the risk is probably different to what you actually perceive it to be, and that they are profitable, growing. Are you going to get the exponential growth? Very rarely do you get a 10 or 15 times return. It happens. And the last 4 or 5 years, you've probably had 1 or 2 in the industry a year of double-digit returns from that point of view. But most of them, 2, 3, 4 times your money in terms of the underlying investments is what the managers tend to aim for, and that's the norm. 2 times your money over 3 or 4 years, brilliant. 4 times, superb. The odd 10 times your return is few and far between, but they add a nice tax-free dividend when it actually happens.
So what are the risks then?
Well, the risks are quite clear that the underlying companies go bust. But of course, a VCT will have 25 or 30 investments in it, if not more. I mean, some have got up to 90. I mean, they've matured into proper funds, for want of a better word now. So, risks that the companies go bust. You've got illiquidity risk. You've got to invest for at least 5 years as a minimum. If you sell before, you have to pay the tax back. And then when you come to sell it, you might or might not be able to sell at a big discount to NAV. Again, VCTs have improved this over the last 4 or 5 years, and most trade on a nice narrow discount now. But if you're selling a lot of shares in that, you test the limit quite easily of how many they can actually deal with. So illiquidity is the main risk, followed by the underlying companies going bust.
And you've talked there about the fact that they've been around since 1995. Some VCTs have actually matured quite nicely and people end up holding them beyond the point that they need to because of the dividends.
Oh, that's the ideal thing about them. You get this stream of dividends, and most of the generalist VCTs, where they haven't got any sector focus, will pay dividends of 5 or 6 pence a year, so 5 or 6% a year. Almost ad infinitum, and that's what they've become very good at compared to 10 years ago when dividends were more sporadic. Now, it's very rare when one of the top quality VCTs doesn't pay you this 5p a year, whilst at least maintaining the capital value as well. So that's why people stay and they look at the dividend stream and go, thank you very much, I'll take that. Especially when your net cost was only 70% of the that price. So if you start grossing up the dividends effectively, your dividend return is 7, 8, 9% in some cases.
Before we get too excited though, we should just say, because they are smaller companies, because of the illiquidity factor of having to keep your money in for five years, these are not core holdings, are these? These are for part of a portfolio which is already well diversified as a peripheral holding. Yeah,
I always look at it and think you should have at least an investment portfolio of at least £100,000, if not more, because the minimum investment for a VCT is generally £5,000 to £10,000. You would like a spread of those as well, so you're probably talking you need 4 or 5, so you need to be able to invest at least £25,000 to get your spread. So you probably need an investment portfolio of 200,000. You wouldn't put more than 10% into VCTs. They are illiquid, they are high risk, you are tying your money up. So, those are the sort of numbers you should be looking at.
Ben, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.